Good evening, ladies and gentlemen. This is Wednesday, April 17th, 2010. This is New York Evening Forex commentary for FX Street, brought to you by Greg Michalowski at FX Direct Dealer. Taking a look at the market today, we did have a pretty ugly day as far as the currencies are concerned. The pound sterling was hit early on the back of the non-manufacturing PMI coming down weaker than expectations, and it spent the rest of the New York day just short covering, squeezing the shorts all the way up nearly to the highs. The euro dollar was also under pressure as Greek debt situation got worse. The yields on the 10-year Greek bond rose to as high as 7.19. The spread versus the German bonds also rose to over 400 basis points. All this is not good news as far as the situation goes for the Greek economy as they try to lower their debts, but they aren't getting any help from the interest rates that they're going to have to pay on the debt rollovers that are going to be occurring in April-May period. As a result, we did see things like gold move higher here today as investors shun currencies and exposure in currencies and look for the safety of the gold contract. So a week or so ago, the market moved above this blue line, this 100-day moving average, and today we rose above this trend line, which took the price back up to a high today of 1,153. There is resistance up here at the 2010 high price at 1,161.47 for the spot gold, and we'll be looking for that as the next target to the upside if this pressure on Greek debt and pressure on sort of bad news all around continues. Let's take a look at the euro versus US dollar. I'll take a look at the hourly chart to start things off. You can see how the market was initially under pressure here, taking the currency pair down to a low of 103.30. The significance of that from my perspective is we had a shoulder here, we had a head here, and we had a shoulder here. So a head and shoulders formation here. If you measure the high to the low, to the neckline, that equals about 130 pips. If you take 130 pips from the break of the neckline here at 134.60, you get to a low of 133.30, and the market went down to a low of 133.26. Kind of caught head, had satisfied the requirements of the head and shoulders formation, and then started to squeeze to the upside here. Other key levels on the euro dollar, taking a look at this hourly chart, is these lows that occurred at the 133.56 level, and also the lows at 133.62 over the last couple days. That is what I consider key levels here for the euro versus US dollar. You can see it better on the 5-minute chart. Now we had a low here, low here, low here, and we also yesterday had lows here at 63, 63, 63 before moving higher. Today, when the market initially came down, we went right into that range there. Then we were able to break through that, but since that time, the market has been able to move back above it until the last hour, where the euro dollar gave up some ground here and is now trading just below that 56 level at 133.53. Also at this level is a 100-bar moving average on the 5-minute chart. So as we head into the night session, if we can stay below this blue line, stay below this 56, 57 level, then we should see further pressure in the euro versus US dollar overnight. There is additional resistance up here at the 200 bar moving average on the 5-minute chart, 66 level, which is also 50% of the day's trading range. So we'll wait and see if the market can stay below these levels right here, and if they can, then we should see further lower action in the euro versus US dollar. Moving on to the sterling versus US dollar, this pair was just all over the place here today. It started the day off going sideways here, and right before the non-manufacturing ISM data, the market spiked up to a high of 152.85. Number comes out and it starts heading right down. Where do we stop? We stop right on the 200-hour moving average at the 151.35 level. The low actually came in at 151.37. Market quickly rebounded off of that, and you can see that we had the market close this hour at a rather high price here, totally rejecting this 200 bar moving average, and that gave the market the boost to the upside. We spent the rest of the day kind of stalling at 38.2% retracement, stalling at the 50% retracement, stalling at the 61.8% retracement. Each of the time the shorts had to cover above these levels, sell against the 38, cover above it, sell against the 50%, cover above it, sell against the 100 hour and the 61.8, cover above it. Currently, however, the market has since come off as we approach that 85 level, and currently testing the 43 level, testing this 61.8% retracement level at this 43 to 45 level. It's probably a good place for the market to stall given the action here today. These types of markets beget these types of markets, so I wouldn't be surprised if we get more of the same type action where the market heads up to a resistance level, fails, and then comes down very quickly. So just be aware of that as we enter into the night's trade. But I would have a bias to the upside if the market can hold above this level. Look for that move toward the 85. If the market moves below this 100-hour moving average, I'm going to look toward support at the 23 level, and then perhaps down to this 152 level on the downside for the sterling versus US dollar. Those levels will start me off in those currency pairs. But again, with these oversized ranges and moves up and down, you got to be careful trading this currency pair. Moving on to the dollar versus yen, taking a look at this currency pair, the market initially moved higher here in the early Far East session, moved above the 100-hour moving average, and then spent the rest of the day moving lower. Once we broke this 100-hour moving average, it's pretty much a straight move to the downside here. There was one point where we did head down, checked the 200-hour moving average, and recovered nicely off of that level, just like we did in the sterling versus US dollar. But we can only get up about midpoint of the day's range, and then the market started to move lower. Now we're below the 200-hour moving average once again at 93.47. On the last when we broke through that level, we came up, corrected right to that line, so that gives it a little bit of a bearish slant. What gives it a little bit of positive slant, however, is where we stalled this move to the downside after breaking that moving average, and that was at the 61.8% retracement of the move up from the low here on March 29th, 30th to the high here on April 2nd. We were able to hold that 61.8% retracement pretty much to a T. The other key the key reason why this level is so important, you have to go to the daily chart. If you go to the daily chart and you look at the 2009 high to the 2009 low price, from here to here, the 50% or the midpoint of that range comes in at 93.12. So not only did the 93.13 level on the hourly chart provide the support that the market needed, but also the 50% retracement of the 2009 low to high range is giving it support here. So as we head into the night session, what level is important? 93.12, 93.13. As long as that level can hold, we're going to look for the market to rebound to the upside here, and perhaps what we're going to have to get through is this 200-hour moving average. If we're able to get through that level, then we have a chance to continue the trend to the upside, perhaps even moving our way back toward this 100-hour moving average. If this level gives way, or if this 200-bar moving average cannot be broken and sustained on a momentum move to the upside, then look for the market to continue its move to the downside and break through this 93.13 level on its way to the next support level, which would be the 60 down here at the 92.86 level. That corresponds with these three lows going back to March 31st. As we head into Far East session, the Aussie versus U.S. dollar is another interesting currency pair. We went out and took care of the made new highs of the recent move today, but those highs were quickly rejected and the market started to move back to the downside. What is of significance, however, from today is we were able to hold this 92.51 level pretty much intact. We did get just a tick or two below that level, but the market bounced off that. What's the significance of that level? If we go to the daily chart, you can see that the 92.50 level, 51 level was the high in March. If we're able to hold that 92.51 level, we have a chance to move, or we should move, continue moving to the upside, and the next target being the January 2010 high price, or the high price for this year, which comes in at 93.28. That occurred here in the middle of January. That would be our target to the upside. So as we speak right now, look for support against 92.51. If we're able to hold that level, look for a move back to the upside with a move toward the January 2010 high. If we fail at 92.51, look for a further corrective move down toward the 100-hour moving average. That 100-hour moving average currently comes in at 92.23. This is Greg Michalowski from FXDD, and this is the evening Forex report specifically for FX Street.